Hey everyone, welcome to another session with our CPA dude to learn more about tax strategies to lower your taxes so that you can boost up your income. So this week is something we're doing is called cost segregation studies. And oh my God, as soon as I learned about this a couple of years ago, I have not been paying taxes on most of like the rental income I'm getting. Although there's other reasons why. Well, we'll talk about that next week offline when I'm not recording this. But without further ado, let me bring in our bestie, my best voluntold, Tony Hoon.
Okay, thanks, Annie. And yeah, welcome everyone spending your evening with us here. My name's Tony Hong. I'm the founder of the CPA Dude. We're a tax strategy, filing, bookkeeping firm, helping you, build a real relationship with you, save money on taxes, and dissect it and make it easy. And tonight, yeah, just talking about cost segregation, one of the best tools in the toolbox for real estate investors, and just like sharing what it is for you, go from 101 to possibly a little bit of 201 and how you can use this strategy, when to use it, and save money on taxes. This is one of the best strategies that you can use. It's not applicable for all situations, but it's a super powerful tool when it's ready. So I'll just go through the slides here, just, a dozen or so slides. And then, yeah, if anyone has questions along the way, just feel free to drop them in the chat and we can answer those. And then we can have some Q&A at the end also with whatever time's remaining. And yeah, feel free to ask questions there. So just diving right in here. So if I'm just going at it, so cost segregation, before we really dive into it, you really need to understand what depreciation is. And depreciation, to keep it simple, is like say, something like a toy or machine loses value and gets older and used more. And depreciation, it's not something you can touch, feel, see. It's just a concept, what it is. So, and this is how I like to joke and say it's like the ninth world wonder of the world. Eighth world wonder is compound interest, depreciation's ninth world wonder. And this is how the rich don't pay taxes. The biggest part is a misconception that some people that get into real estate have is that you get to write off your principal on your mortgage on your taxes, but that's not the case. You only get to write off the interest and you get to write off depreciation is the remaining part. So depreciation is just a really strong tool. However, if you're not going to be utilizing it the right way, you're going to be losing out a little bit here. So depreciation, just I want us to line this up and know, hey, this is the key part and why cost segregation is going to matter for you here. So I'm diving into like, what is a cost segregation study? Fancy word, and keeping it simple here, it's just splitting your house into smaller components. And that's all it is. It's a expensive study and it's not cheap, but it has tons of benefits on that. And for, I don't know if I have a slide on it, but we'll just talk about it now in terms of you do kind of get what you pay for when it comes to cost segregation. And there's various reports and styles that are out there. You got some that are, I think I've seen some for 500 bucks. And I've seen, some of them, 2.5, 3.5K for single family homes. Commercial is a lot more expensive just because it's a more extensive study. However, the biggest part when you're considering a cost segregation study and how much to pay for it is actually the quality of the report. And what I mean by that is that there are different, what do you call it? Different companies and how they do their cost seg reports. The low end ones that I'm seeing that are coming out, especially with the AI revolution right now, is they're just popping this thing out and I see the end results and they don't look that good. They just kind of break out the house into simple components and it's barely a detailed study. And I think if it comes under audit, I don't think the audit technique guide is going to stand up under audit. So those are like, buyer beware. If you're okay with just getting a number to put on your taxes, those lower end studies may be better. And then you have something in the middle of the road where you're able to get a more detailed study that lists out all the different components into 5-year, 7-year, 15-year buckets. And those are pretty good middle of the market, probably about 2K on that side. And those are pretty fair. And then there's like the top tier where you're probably like about 3 to 4K on that side. And the difference at that level is that you're paying for audit protection too. And these nicer cost segregation firms, they're actually certified. So there's some American type of institute that like where it's like kind of like a certification of like how high the level of cost seg is this company. It's not some fly-by overnight part. And one big distinction that you want to look up when you're evaluating your cost segregation vendor is what's their track record? Have they been doing this long? I would say it does kind of matter in terms of how long they're doing it for and what their reports and their audit support look like. So before you just buy something too cheap, do consider what are you willing to pay for. If it comes under audit and the study's completely disallowed, there goes your deductions, along with some penalties and interest and taxes that you owe from the savings on that side. So that's kind of like talking from a price perspective. And then going through here, so depreciation, the by default, the IRS thinks that, it's straight line depreciation. And what they're saying is your whole house, the whole thing is got a 27.5 year useful life. And because of that, they say that's all you get. You take your house, subtract out land value, and divide by 27.5, and then that's all the depreciation you get. However, we all know that's like not true. Like floors don't last 27 and a half years. Like windows don't, cabinets don't, doors don't. Like these things and the components in your house, they don't last 27 and a half years. So it's not very true compared to what the IRS says. And using a example here, and we got a special house, blocked out a couple numbers here, but using Creeley here as an example for straight line depreciation is, let's just say you bought a house for 307 and you have the land value, so you can't depreciate land, you have to subtract out land, and that leaves you with a building basis of $245,000. And now that the building basis is 245, you divide that by 27 and a half years, and that simply will mean that you get $8,909 of depreciation each year. And it's not a ton that you get here, but it's better than a little like smaller amounts of you didn't invest in real estate. So straight line depreciation, very easy. Take your purchase price, subtract out land, divide by 27 and a half. Very slow, and like it'll take you 27 and a half years to recoup your purchase price minus the basis or the land. So you have your basis. So it's not bad, not great. It's still better than nothing. And it's really why real estate is such a great investment vehicle for investors to pay zero to little taxes on the rental income. So for example, if you have, let's just say this house produces, $1,500 of rent per month, and they'll leave you with $18,000 in a year, you'll almost get $9,000 off already just from the depreciation. And depreciation is a non-cash expense. You're not actually paying out $8,900 to get that expense. You just get it automatically for buying a house. And it's on 18,000, take out almost 9,000, you're down to $9,000 taxable income. Add in some property taxes, add in some repairs, insurance, and that income pretty much comes to zero. Like if you're doing your taxes and you're paying income taxes on your like rental real estate, there's something wrong with your tax return and you need to second guess it. I had one client that came to us, did the whole return, and then I was just like, something looks off on here. I was like extremely positive, even after depreciation. And 9 times out of 10, you never have positive income on tax returns as long as there's a mortgage on it. And the dude had a mortgage still. So then I called him up and I was like, are your numbers right? And then he said they were right. And I was like, you sure? And he's like, no, I'm sure. I'm like, okay, cool, dude. And then I asked him, like, what do you do? And then that's when he told me he does the pad split, the rent by the room. So taking, a 4 bedroom house, turning into 8 bedrooms. I'm like, that's why it's so profitable. Like generally, you don't see it that often from a real estate side. So that's the best part about real estate is that generally speaking, you shouldn't pay any income taxes on the income that you do earn. So this is straight line depreciation. I just want to set up this foundation for everyone here to understand because the next part is really when cost segregation comes in now. Let's see here. Okay, cool. Do we want to answer some questions? Okay, maybe I'm gonna just take a pause here and answer some questions. All right, questions drop in here. I'll bring it up appropriate time. Or Annie, I guess you bring this up or I bring it up. Let's see. Meme slides. All right. Accounting, one professor was educating me like this.
Well,
Nice.
some of the questions you're actually going to address that in the like toward the end.
Oh, sweet. Okay, cool,
Yeah.
cool. Sounds good. I'll let you ask the questions, and then
Mhm.
in the meantime, I'll just keep on steamrolling because it's not that many slides on here. So I always want to save more Q&A for folks. I think that's more useful for everyone than me just talking about taxes. So I'll go through the slides here quick just so we have more time for Q&A.
Mhm.
So now that we have straight line depreciation, now we got to talk about accelerated depreciation. Accelerated depreciation, this is the good stuff. And, I would say there's straight line, which is good. Accelerated is better. Bonus is best. So good, better, best. And accelerated depreciation, this is where cost segregation comes in. So without a cost segregation study, you are not able to use accelerated depreciation. So you have to buy a cost seg study in order to take accelerated depreciation. But here, like, why do you want to do this? The reason why is now I have the same exact home, no difference in terms of purchase price or land, building basis is still the same. However, the cost segregation study, what they do is, like I said earlier, was just I wonder if I can use the little things here, is that you're just splitting your home into smaller components. So instead of the whole home being at 27 and a half years over here, now it's into 5-year components, 7-year components, 15-year components, and 27 and a half year components. So now you're splitting the home into smaller components, and now you're able to take more depreciation. The reason why is because you're taking 24 and a half divided by 5, 36.75 divided by 7 years, 61 grand divided by 15 years. So that generates $18,687 of depreciation now. Compared to previously, you're getting 9,000, almost $10,000 more of depreciation. So just using this one small tactic here, you're able to almost double your amount of depreciation just by utilizing this study. So if your property is highly profitable, generally speaking, if you have say a midterm rental, a short-term rental, or you just got a house that you inherited and or the house is paid off, those houses generally tend to be very profitable, and you need to find ways to reduce the taxable income. And just using a cost seg study, you're able to generate an extra $9,000, $10,000 of depreciation now. So this is the magic of a cost seg study. You're simply just splitting it out, and now the denominator is a lot lower. You're able to speed up and aka accelerate a lot more depreciation. So that's accelerated depreciation. And then your next portion here is your bonus depreciation. So like this is like the cherry on top, the sweet stuff, the good stuff here, and compared to straight line and accelerated depreciation. Once again, you can't get bonus depreciation unless you have a cost segregation study. And just painting an example here for bonus depreciation is same exact house again, same purchase price, same land value, same building basis, and all the components are the same. But now, assuming 100%, and this is in red for everyone here, technical rule as of today is it's 40% in 2025. However, there was chatter from Trump, actually, I just saw, was that 100% bonus depreciation would be brought back for 1/1/2025. So 2024, for sure, it's just going to be 60%. No need to like try to extend your return like you had to do last year to see if it was going to go retroactive. Like 2024, it's all said and done, nothing's happening. But assuming that it's going to come back to 100% bonus depreciation, and fingers crossed that it will. My personal take is it will, but I could be wrong. Don't got a like a magic 8 ball in front of me. But if we use 100% bonus depreciation, now so bonus depreciation only applies to property that is 20 years or less useful life. That's why it's so important to have a study that breaks it out into 5-year, 7-year, and 15-year property, is because you can take bonus depreciation on anything under 20 years. So in this case here, we have 122,000 that you're able to take in the first year compared to if you did straight line. So you're getting $113,000 more compared to straight line depreciation. And then if I click back here, this was 18, almost 19 grand, and you're getting 122. So this is an extra 103 if you take accelerated depreciation versus bonus. So yeah, bonus depreciation, this is really how you don't pay a ton of taxes. Like if you're kind of playing the game right, so if we're going back into more financial talks, is if you're in a 30% tax rate bracket between federal and state, 30% on 122 grand is almost $36,000. You could do 10% down and you're probably all in at 40,000 for with closing costs, right? On 10% down. So practically this is a free down payment if everything plays out the right way. So this is, once again, assuming that either you're going to have a short-term rental, real estate professional status offset active income, or you just are very profitable in terms of your real estate. So bonus depreciation is huge, and it's really how the rich don't pay taxes, like Grant Cardone, Robert Kiyosaki. You just keep on buying more property, and that's the name of the game. However, the bad part is it's kind of like a drug. Like once you start, you can't stop though. Like the day you stop buying rental properties is your depreciation kind of stops. So if you want more depreciation each year, because you're depleting all of it each year, because the only remaining part, so this is only the downside of it, is that you only have 122.5 divided by 20 some half years left on it. So that's only about 4,500 bucks a year. So bonus depreciation is the cherry on top. And for you guys here, is like you don't have to do bonus depreciation. You could just do accelerated depreciation if you want to do a cost sake study. Because say if you don't have real estate professional status, you don't have short-term rental loophole, and you're like, I just need an extra, 10K to offset some of my rental income. That's fine. Then you can space out your deductions throughout the year. And if you want the whole shebang, though, you can just elect it. So it's a choice. It's not a one size fits all type of answer. So that's like the general premise. So like that's like the 101 side of things of like, hey, you need to understand depreciation, non-cash expense. Cost segs, simply just split it out. And then you have straight line versus accelerated versus bonus. And then that's like the general core concepts of this. Like tax has a lot of confusing terms. All these fancy big words, I don't know why. They have to like make it like that. It's just confusing for everyone. But just to keep it simple for everyone is that's all it is in a nutshell. And the other parts here is like, who does this apply to? Is, there's a few folks, the easy slam dunk ones is if you're a real estate professional, real estate professional, what does that mean? A real estate professional simply means that it's a special tax status in the tax code. And it simply states, do you work 750 hours or more in trades or businesses of real estate? Number two is, do you have over 50% of your time in those trades or businesses? And then lastly, do you have material participation? 7 different prongs. Two that most people meet is 500 hours across all properties or 100 hours and no one else works more than you. So that's the first group of people who it applies to. The second group of folks that it could apply to are your short-term rental folks. So if you're doing Airbnbs and you want to offset your W-2 income, this is like our go-to tried and true strategy for our W-2 folks to reduce their income. So your STRs is your next population. The third population, I would say, would probably be the folks that have a paid off home or a very highly profitable home, like my one client where I thought his books were wrong, is that even if you don't have real estate professional status or short-term rental, and you're that profitable just because you don't have mortgage interest to write off, or you just have that much income coming in, that's another good population. Number four was the mom and pop exception that we did. Andy, that's what we did with you, right? Is that we could just use the mom and pop exception. So if you're under $150,000 adjusted gross income, you can actually be a mom and pop investor and you can wipe off a good chunk of your rental income on that side. And then the last population that could apply possibly would be commercial real estate. And possibly the reason why is that if you're triple net and you pay for nothing, like you have no expenses. So if you don't have any expenses, then you need to actually, and you're, the commercial, you're charging premium. You do need some type of extra expense. Otherwise, you're just going to pay income tax on it, which is not the end of the world. The best thing about rental real estate is that it's not subject to self-employment taxes. So that's your Social Security, your Medicare taxes that you have to pay when you're working a W-2 or you're self-employed. But if you have the ability, why not run it? That's why cost segs are good for commercial real estate is you're just so profitable. So that's who can use it. And like I said, it's just a tool in the toolbox. It's not an instant like, hey, I bought a property, I'm going to run a cost seg on it. And they are expensive. It's not like you just want to buy these like left and right. And then, yeah, when do you use it? When is generally, same thing for the same categories of folks is real estate professional status people, short-term rental folks, highly profitable properties like commercial real estate. That's when you want to bust out this tool. The other hack too that you can use actually is if you're like an aspiring real estate professional and you're not there yet, but that's the journey you want to end up towards. So let's just say, for example, you have a doctor. This is actually the classic combo. You have the doctor, and then you got, the real estate investor combo. One person makes a ton of money. One person is focused on making money with the portfolio. What you can do is say if you don't qualify for real estate professional status this year, just say you said you had a mid-year, you just quit your job, you're not going to qualify with the 750 hours. You could just wait and then run your cost segs. Or when you like say, hey, I end up of corporate, like peace the hell out, I'm not doing this no more. And you become a real estate professional status, then use the cost seg. Like you don't have to buy the cost seg in the year that you buy the property. Yes, does it make your life easier? Yes, does it make my life easier? Yes. But you could just wait, say 3 years. You're like, okay, I'm ready. I got 750 hours. I can fully manage this properties by myself. Then what happens is that all the depreciation you didn't take before, you can actually all take it now. So that's kind of good for if you're not ready to be reps yet and you're planning on it into the future. Another good strategy for you there. And then something that just popped in my head as I said that, not ready for reps. Maybe it might come back to me.
Or
Can't
does
remember.
it also make a difference of like how nice your house is? Or is it when, like if I just bought it and I want to do rehab, or should I do a rehab first and then do this?
Oh yeah, it would probably be a lot easier and cost savings if you bought it and then you did your rehab and then you did your cost seg. Just so when they do the cost seg study, it comes in at the full like renovation cost. Oh, one thing too, when you do your home renovations and when you do your cost seg studies, one hack actually, especially right now since bonus depreciation is phased down, is to actually use the de minimis election. So I guess anyone that has rental real estate, you can like elect this on your taxes if you want. But essentially it's an election that says anything under $2,500, I'm not going to depreciate. I'm just going to expense it right away. So it's just an election that you make on your tax return. The biggest use case of it is say washers and dryers. Like they may be five. I don't know why I have me right now. Okay, you have 5 year, 7 year, so I'm sorry, a dishwasher or a, what do you call it? Washer dryer. They are less than $2,500, generally speaking. At least the ones I say. I don't know what kind of fancy stuff people buy these days, and you're supposed to depreciate that over 5 years. But with the de minimis election, you can just say, hey, I'm going to expense it the full year. Same thing with laptops. That's another classic time. Buy a 2K laptop. Yeah, are you supposed to depreciate over 5, 7 years? Yes. But with the de minimis election, you can just use that and expense it the first year. So where I'm going with this is that before you give your report to your cost seg person, or if you do give it already, just let them know, hey, anything $2,500 less, I'm just going to expense it the first year. That's how you can squeeze more out of your cost segs. So yeah, once again, just there's a right time and place for it. Oh, the one thing that popped in my head was there is a certain point of time where it doesn't make sense anymore to do a cost seg. Generally speaking, once again, it depends on how much the house is. A $5 million house is a lot different than like a $50,000 house. But generally speaking, it's 7 years or less since the property has been placed in service. So let's just say you had a rental property and you put into service in 2016 and you've been depreciating a straight line each year on TurboTax. And then you're in this webinar now and you're like, oh, what? Cost seg? I mean, this is like great. This is amazing. The ship kind of sailed on you already because it was placed in service in 2016 and 9 years have passed. And the 3K that you're going to spend is not going to save you enough money to offset the fees and enough taxes. It's not worth your headache after 7 years. So that's what I remembered was like after a certain point, It's just not worth it. 2, 3, 4, 5, 6 years, great. Still run the strategy. It's going to work out fine. Of course, it's case dependent. And then, oh, actually, let me show you this one. Oh, study. Let me see if I broke it out. So I actually did this one where I wonder if I can find it. I did a comparison of a cheap study versus an expensive study and the ending results towards it. Oh man, it just popped in my head. I should have brought it, but I wonder if I can find it. It'd be cool to show. Oh, cost seg analysis. I do have it. Cool. So here's actually a cool part. So let me show you this. So, oops, I should probably delete that name out. Okay. Annie doesn't, but yeah. So this is a say, premium vendor, primo vendor, and then savings with primo
Oh,
vendor.
that's my buddy.
Yeah, yeah. Yeah. It's always hard to like try to keep names going, but it's all good. So, okay, so you can see the Excel sheet fine, right? Or should I blow it up? Cool.
Looks good.
Okay, cool. So this is actually a real use case from one of our clients. So what we did for them, like I don't care who you use. We actually have a white label vendor we use ourselves now. But like at the end of the day, you got to find who's going to give you the most depreciation. So this was a $675 study and their findings on their estimate of benefit. So cost segs, you can always go get a free quote, right? It's always free to get the quote. So you should always do it. It's just your time is all. And they found 56,000 from this one. Then the premium vendor, they found almost $96,000, but it's going to cost 4,000. And most people, they stop here. They're like, 4K versus 675. They're like, I'm not paying 4K. Like, pay 675, right? So, but the key difference is you have to compare it in terms of how much more you're going to save. So what I did here was I took our client's effective tax rate, so 16.6%. And I took what's the difference, right? The difference is 95 minus 56, $39,000 more of depreciation. And I'm going to take that $39,000 times their effective tax rate. And I'm like, you're going to save $6,574 more. However, you're going to pay, 4K minus 675, you're going to pay 3,000 more. But even after that, you take the extra from the savings minus the extra cost and fees, you're still going to make another $3,249, even though you're spending an extra $3,325. So this kind of shows you like you do get what you pay for. And I know it's always a tough pill to swallow, especially if you run on like paper thin margins of like $100 a month of like net income on the property or you're losing money. Like it's just like 4K, what? But if you're really running the numbers and you're doing your planning right and taking the time to do this, the premium vendor actually won. So this is the biggest portion here of like why you should use a more expensive vendor versus or just get quotes, I guess, is the end of the story and compare. So that was the win. And then what's my last slide here? Oh, sorry, I'm just talking about vendors right now. So yeah. So it's too expensive. So that's really just how you can compare against what you want to do and what you want to invest. So take the benefits, estimate how much you're going to get. The other part that I would probably recommend, let me go look up what it's called. It was like this cost seg council something. And essentially it's this one. It's called the American Society of Cost Segregation Professionals. Essentially, like if that cost seg firm is certified by these guys, that's more or less a legit firm. There's a lot of like flyby overnight AI ones that are coming out that are just not going to be that like foolproof. Like when you see a study, the schedules you can see, if it's a very detailed schedule out, it's going to be a good one, it's going to be supported. And then if it's just a very blank, easy one, it's probably not going to be as good. So that's another thing to mention on vendors, just be mindful of it. And then the other part is just like how much audit protection do you want to spend also? So that's another one, like how much peace of mind do you want to have? So a lot of these, they have audit protection, so if it blows up, I'm like, all right, cool, just go contact XYZ to go defend yourself there. So that's pretty much everything from the cost seg side. And then, yeah, we just have a contact us form. So we do have a little special for everyone tonight. So if you want to grab onto our planning and advisory packages, do have a little discount for you there to get a grand off. And then scan the QR code, you can chat with our team on that side. So that's pretty much everything I had from a cost seg side. And we can hop into questions on that part or comments. And if anyone else has questions, feel free to raise your hand and we can chat here also.
Cool. All righty, and let me help you organize some of these questions.
Okay,
So
cool.
it always sounds great, but there's always a catch to stuff. So
Yeah.
let's go over some of the catches on cost seg studies and who should not be doing these.
Oh yeah, yeah.
For what
Yeah,
reason?
there's always a catch 22. I was actually playing around with podcast names for with my little sister, and I was like, should I start something called the Cash 22? Kind of like a catch 22, but like Cash 22. But yeah, there's always two sides of the coin. Like if anything sounds
Like
too good,
that's why we were called the It Depends series,
yeah,
right?
exactly. Like it's not all sunshine and rainbows. So all the downfalls here of cost segs is number one, they're expensive. Like if you don't got margin to do this and you're not going to find a tax savings through it, you should not do it. It's expensive.
And then
Number
explain this margins thing, because is that why you told Mikey not to do it?
which oh Mike, yeah. Oh yeah. It's just because if you're already in loss positions already, you don't need to, right? So if you have a nice expensive home in the Bay Area, your cost basis in your building is so high you have enough depreciation to offset it. So only when you're positive is when you want to do it. So if you're not real estate professional status, you're not short-term rental loopholing it, and you're just doing straight like midterm rents, but your depreciation still offsets it and you're negative, then you don't need to do it. The reason why is that if you go negative further, all you're doing is just banking in your losses. So you're creating this fat piggy bank losses, which is great, don't get me wrong, but you're not going to be able to access that piggy bank until you have passive positive income. And passive positive income does not include stocks, dividends, interest. You think that's passive because you're not doing anything. But in the definition of taxes, it means it's from rental real estate or passive K1 investing. So that's actually another tax strategy I like to tell our clients is that you could actually use cost segs to offset other active income, or sorry, other passive income. So the go-to is that, say, if you're a silent investor into a business and you're getting a K1 from it, and say you're investing in a restaurant, they're turning you a $10,000 K1, your losses from your real estate can actually be used to offset that K1 actually. So this is why you want to get into business investing on top of real estate investing too, and just to diversify your income furthermore. So that's why you don't want to run it. Number two is if you're going to sell the house in the near future, like say you have a house this year or last year, sorry, we're doing 2024 taxes right now. And you're like, should I run a cost tag on it? I'm like, yeah, it depends, right? That's always the go-to answer. And if you plan on selling in 2025, like it could work out, it could not work out. The main thing is like, is the squeeze worth all the extra tax savings you're going to get? And you're going to get like a interest-free loan. So for example, if you're going to save $25,000 and you just have to pay 2.5K to get that extra tax savings, yeah, why not? You're going to get a free loan from the government for 22 grand interest free until next April. So yeah, take the hit. But if you have to, you're only going to walk away with say 8 grand, right? After fees and everything, then is the juice really worth the squeeze? So that's one part. The other portion is, so if you're going to sell it, what else would you not do? Cost segs. Let's see. Yeah, you don't have other income to offset. Really makes no sense. And then sell property. Oh, I guess. Oh, probably the biggest one I just forgot. You have to pay depreciation recapture. So depreciation recapture, what that simply means is if you buy $1 million home, you use a 20% land value and you have $800,000 of depreciable basis. Actually, I'll just go back to this other slide here. Let's go here. Back to this one. Is if I took $122,000 of depreciation my first year and I decide to go sell it in a year or two, I'm gonna have to pay back 25% depreciation recapture on 122 grand. And then the rest, anything in excess of my depreciation basis, I just pay ordinary or long-term cap gains on it. So you do have to pay back the depreciation that you did take. So it's a rob Peter to pay Paul game type of strategy. And it is a deferral. One other way to really make it work for you is that you could keep on 1031 exchanging your properties. However, the depreciation on the first property you took already, you don't get it. You just get the increased in the new property. So you could defer it. And then lastly, when you do pass, then of course, all the depreciation comes back. So this $300,000 house, say you depreciate the crap out of it, there's only 62K of land left after 27 and a half years. Now, if say, whoever owns it passes and the house is worth 2 million now, your new cost basis is $2 million. So that's kind of like the buy, borrow, die strategy is more or less is like, that's where you keep the properties in the family's name. The other big part here is that you don't want to do, and I feel like us Asians love doing it, or our parents do at least, is gifting the house to us so they can qualify for, say, medical or food benefits, those type of items. You do not want to do that. The reason why is because you're going to lose out on the step up in basis. So just don't do it. Just put in trust, let the time just phase out and wait for it. It's kind of like the number one like no in terms of from a tax perspective. So let's see that what else is bad about cost segs? Oh, um 2 or 3 years ago for TurboTax, they couldn't do cost segs. Like not the cost segs, they couldn't do bonus depreciation on TurboTax online. You had to do it um, via desktop software, but you had to be pretty savvy on how to override it. So, AKA the downfall is you're gonna have to hire a professional to do it. And professionals, it's not a cheap service. So you're gonna have to pay to play. So that's another downfall of doing cost segs. You gotta pay a CPA or a competent tax preparer that knows how to do this, the right to do it right. And then of course the cost seg fee. And let's see that. Oh, I guess you do have a higher chance for audit too. So there is a special form. So if you say the property is more than 1 year old, and say you bought the property 3 years ago and you're like, oh, sweet, learned about cost seg, I'm gonna use the strategy now. The issue is that you have to file this form called the 3115 change of accounting method. And that form says, this is how much extra depreciation I'm gonna take this year that I missed out on the last 3 years. And I'm going to take bonus depreciation moving forward. So once you tell the IRS this, one, your 481 calculation needs to be spot on. So they'll poke holes there. So once again, you do need a firm, or also this is why I like more like premium cost seg vendors because they actually do the full calculation for us. I just don't like doing it. It's hours of work. So it's just nice to have a pro to do it. But then once you submit it, you also have to mail and fax the 3115 to the IRS. So there's two divisions that's getting it. So it could raise a red flag. I'm not saying it does, but it could. So also because you're taking such a large benefit that year. However, good news, or I don't know how you say it. Good news or bad news. I think it's good news for, well, it's good and bad for myself, is the IRS workforce has got cut by 55%. So it went from 100,000 agents to 45,000. So if you ever want to call the IRS, it's probably never going to happen. One guy on my team, actually, he was a former IRS tax auditor. He was calling the IRS today, and they hung up on him after 30 minutes. They used to let you go 90 minutes before hanging up on you, so they hung up on him after 30. So that's bad. But the good silver lining in all this is there should be a lot less agents now to audit you. So if you want to take more aggressive tax positions, so we're going to probably bring this up with most of our clients, like, yo, do you want to take more aggressive positions? Like, because if you're statistically speaking, there's just less agents to audit you. So it could be a time for you to hit these positions. Of course, contact your tax advisor or can you contact our team, but yeah, I'm just saying like it may be a good spot. It's actually how big corporations, the Fortune 500, the trend, what happened was during Trump's time in office the first time, they took more aggressive positions. Then after Biden got the budget to hire more agents, then Fortune 500 actually took more conservative tax positions. So knowing what the data is now, I would sure as bet that Fortune 500 is going to start taking more aggressive tax positions again. So it's just how you really play the game. Like the tax code's there, it's written. you just got to play it the right way. And at least it's like real estate. Real estate is the big one, small businesses is the next one, and then charity. If you're not in those three hats, I always say, hey, you're not going to be in a tax advantage way, and which is fine. It's just like you're gonna just pay your fair share, and you can't really complain about it. So, but yeah, good question on who should not do cost segs and the downsides of cost segregation studies.
Cool. Next question. You kind of did, I think you answered this one already. It's is it true you can't do a 1031 exchange with a property that does cost seg?
You can, however, you do lose out on the original depreciation that you took already. So you only get the incremental value of the new building. So it's even so in our example here, if you took the 122K already, you don't get that extra 122K when you 1031 again. However, it does defer depreciation recapture though. So it's a good way to push it out. Opportunity zone, same thing too, deferring when the taxes are due. So general strategy of a lot of taxes is deferral. And deferral is even as easy, like you're probably doing it today and you don't even know, is you're doing your 401ks, right? All you're doing is just traditional 401ks, not Roths. Traditional 401ks or 457s, 403Bs. You're just saying, hey, take my 20 grand, reduce my W-2 by that, and put it into my retirement account. But then you're going to get taxed on it when you're 59 and a half. So it's a deferral strategy. Same thing as 1031. The only way to escape taxes is like pretty much spending the money or you pass away. Like that's the only real way of eliminating tax elimination style.
Or cash out refinances?
Yeah, that's true too. Yeah, you take out the money and you're not. That's actually a good one just to like iron out that one really quick is when you take out loans against your properties, loans are not considered taxable income. It's all tax free. So you could take that money to go make more money and like get more depreciation. So if you have properties with good equity inside of it, utilize that equity more and get more depreciation out. But I would really pay attention for this year. If it comes back to 100%, like start buying, go lower. If it's not, I'd still probably hold off until they get clarity. So current tax laws, they expire at the end of 2026. So that's why this year is a massive tax reform year.
And then if it's gonna reform in 2026, when do you think the news are gonna come out? Like to be like the real answers of what's gonna happen.
Answers, I'd probably say the fall. Yeah. This is my best guess. Yeah. So yeah, they're gonna go through it, right? But what? Both sides are controlled by one party, so whatever's going to come through. So, but no,
Mhm.
I'd probably say something gets introduced. The first House bill passed, but they didn't include jack squat in it. Like we didn't see any details about taxes. So I'm curious what the underlying part is. And the other big part that's fun from a tax news update is state and local taxes. They're going to try to change the cap. So right now it's $10,000 between property and income taxes. And, anyone in California who owns a home, like, blow that out of the water right away. So there's very many variations of it. There's 20K, 30K, complete lift. So stay tuned on that. Good news overall, though. Like for sure, something good is going to happen from it.
Great. So, and then let's go back to talking about the companies and the premium ones. Would you say that the cheaper ones that you had mentioned, like that 671 or these online ones, are more likely to get audited? And would you have any ones like, maybe or companies that you just recommend to stay away from?
Yeah. So in terms of the companies in itself, first part is one the first part is what's the end result, right? You do, a lot of things in life, you get what you pay for, right? So if you're going to spend more, generally speaking, it should result in a better part. So, like in this case, I would still spend the 4K on this rate just because I'm going to get an extra 32.49, even though I'm paying an extra 33, because my real savings is 6,500, but they took 3,300 more, but I'm still winning by 3,200. So generally speaking, you do get to what you pay for, right? So it's hard to justify. Don't get me wrong. Like this is mathematically speaking. I mean, if we just say this divided by here, right? We're us Asians, we're just going to be like, yo, this is almost heck. Like, why would I pay 5.9 times more? But if you haven't done this yet, this is the key part. If you're not doing a second step, you're missing out. So just to reiterate, you do get what you pay for.
So
However,
is the
yeah,
first company like an online DIY thing? Is that why it's so cheap?
yeah, we recommend them actually to our clients too. Well, we recommend all of them. This is like, how much do you want to spend? Because even when I run this to people, they're still like, I don't got 4K. I'm like, all right, cool, man, just do this one. That's fine. So yeah, no, we have an affiliation with them. And then we have affiliations with our premium vendors. We have affiliations with our white label solutions too. So they're all up across the board. It's just how much do you want? Everyone has different budgets, right? What's the one store? Old Navy, Gap, and Banana.
Yeah, I'm
It's all the
like
same stuff, right? But I'm sure the quality is a little bit different. Like Banana might be able to sustain an extra 20 washes compared to Gap. I don't know. But yeah, so the other part about from an audit side for the cheaper companies is so say you pretend like, hey man, I don't got 4K. Like I got $675 to spend on this just because my property got ruined, right? Like idiots broke in, trashed my thing. I don't got money to pay. Cool, that's fine. The from a tax reporting side, we put the same numbers on your tax return. The IRS doesn't know. It's when the audit comes, if it comes, and they look at the schedules and the supporting documentation, that's where you will generally lose when it goes to a cheaper study. Like the USTGI studies, they actually come out fine. That's why we still back them, is because it's fully detailed, like the 5-year, 7-year, 15-year properties. Like it's a full listing of, they break out every component. We trust that. But I've seen some stuff, man, not to name names. I guess I should name names actually, screw it. Is DIY cost seg, right? Is I don't it's just not I don't think it's not gonna come under like so how the IRS audits, they have a thing called the audit technique guide, the ATG. That thing will not sustain under an audit. That's the only issue with it, right?
dude, and Sayre homies have to watch out because like the one you just mentioned, I've seen it a bunch of times inside Sayre. And people go like, "Oh, you're looking for Casa, you want to do cheap one." That name always pops up.
Yeah, yeah. I seen the report, and I mean, at that point, don't even spend the $400. Just go into AI and do it at that point. I mean, if you're that cost conscious about it, I mean, you might as well just roll your dice and wait for it because you're gonna like that report's gonna blow up under audit. So why wouldn't you just go save your $400, roll the dice, just AI it and call it a day, really, right? So that's another portion of like the cheaper vendors is that it's gonna blow up under audit. But then once again, like I said. Are there less audits? Maybe statistically speaking, since there's less people now working at the IRS. So it's really up to, I always tell our clients that, hey, like risk, what's your risk tolerance? Are you like a nun, you go to church, and you got zero risk? Cool. We're paying for premium. You like to go to Vegas and gamble? Cool. Roll the dice. I don't care. Use AI. That's fine. It blows up in our audit, it's not our fault. So it's kind of like really up to the taxpayer and their positions.
Yeah, and then for those who are in here to kind of wonder what the experience is like for hiring someone like this, that you approach them first, and then they'll give you like a sample of your estimated savings, and then in terms of the time frame and what really happens is that they're going to send an engineer out. You pretty much will work with a company that's national wide, so that it's they could service all 50 states. And then the engineer will schedule a time and they'll visit your properties, take a whole bunch of pictures, do some measurements, then they go home, run the report. But my guy was pretty fast. He was able to get it back within 2 weeks. And then you will connect the guy or the report and you hand it over to your CPA. So in terms of time frame, it's pretty quick turnaround. So you can so in knowing that though, Tony, what was the deadline of the year that you just have to get this into make sure it counts for your this year's taxes or the 2024 taxes? Like, is it too late now if it's March?
Oh no, that's a good thing. So you want to, well, to file your return and not extend, it's too late. Just because generally speaking, cost seg vendors are really busy right now. But you can extend your taxes. Once you extend your taxes, you'll have till 10/15 personal, 3/15, or sorry, 9/15 for partnerships. Then you have all till then. So then you can submit your study in the summer. Give it I'd say like worst case scenario, 2 months. That's another thing. Like Annie, like you mentioned, right? Like boomer tosses, he gets his stuff done quick, right? Like versus cheaper folks, they've taken like 2 months. And as you once again, you're paying for speed. What's that one joke in the construction world? Like, is it speed, quality, and price or something?
You can only choose two.
You choose two. Is that the joke on that? I forget what's the joke, but yeah, you only get two, right? So it's same thing happens with cost. I think it's a general principle of life actually. And yeah, so you want to give a 2 month buffer, I would say just to be safe. So yeah, 9/15, get your study submitted by say just July 1st, just to be safe. Just because you have to be mindful, like then you gotta give it to your CPA, and then we prefer not to have our shit last minute. So
Unless your name is Annie. Just
yeah,
kidding.
then we stay up extra hours. Yeah, but yeah, that's the general time frame. But it's not too late for 2024, so it can still apply. But 2024, oh, the big part from a strategic side is from 2024 is what do you call it? If bonus depreciation is going to come back to 100%, you may just want to skip 24's bonus depreciation because you only get 60%. That remaining 40% has to be done over the last, the next five. Because, like, let's just take this example right here is you get the, so using 60% here, you take 24.5, times 0.6, you get 14,700 in 2024. Then the remaining, 10K, you have to wait the next 4 years to get. However, if you just wait and if it retro goes back to 100% for 2025, then just run the full cost seg, you'll get the full 24 grand the first year. So you may want to delay it. However, unless you're banking, that was your tax strategy for the year, just don't do it then. Because time value money, right? You can take the money today and just make more money later. So that's from another timing and strategic side of how you want to approach your cost segregation.
Got it.
Yeah.
So more with the combining strategies and it's related back to the 1031s. Can we use this in instead of like as instead of doing a 1031, can we use cost seg as a lazy 1031?
Oh yeah. That's like the half of the other strategy. So for anyone on the call that's like not familiar with the lazy 1031 exchange, so a real 1031 exchange, you actually have to identify your property within 45 days, close within 180 days. You have to use a qualified intermediary like Wei Ming, right? And that's a real formal one, right? There's a formal process you have to do. However, say you don't want to be constrained to the 45 days of identification, 180 days to close, you can do what's called a lazy 1031 exchange. It's not a real thing, it's just slang. What it essentially is that you sell one property, the one that you have right now. You don't do a 1031, you just wait and find a new property for the new year or for the current year, and then you just run a cost segregation on it. So then the gain from the first property will be offset by all the depreciation from the second new property you bought. So it's called a lazy 1031 exchange, not in the tax code, not a real thing. It's just a slang term.
Cool. And and that reminds me, I remember why I did that so late that one year to annoy you. Because I
Oh,
had that 1031 with boot left over and that saved
oh,
my butt.
oh yeah. That one was yeah.
That was a good one. But
1031 hurt. Yeah, those are not easy either.
we didn't even plan for it. It's like, oops, but hey, it worked out. So that was kind of cool.
Exactly. Yeah. So yeah,
Learning from mistakes, and whenever I stress you out, that's that's how we get more tips. Well, next question is, let me see, from Andy. Is it so when we're talking about these prices, and then your building status, and you have these numbers broken down,
mhm.
are the numbers based on the appraised price, your purchase price, or assessed price? Like how do you determine how much it's getting depreciated, or in terms of like financially?
Oh yeah. So yeah, great question on that side. So in order to determine the numbers for your cost segregation, you just generally speaking, you just provide them the closing docs plus the improvements that you made on the property over time, plus your depreciation schedule, and then they will take it from there. So it's not based on your appraised value, it's not based on your fair market value, it's based off of what you paid for it. So all the money has to it only goes based off like what you bought it for. So That's the big part. And then on top of that too, what was slipping my mind there? Oh, the land value. So value is very subjective, and generally speaking, you need to have it tied to some type of document, and 9 times out of 10, it's generally speaking the county assessor's ratio. So you just take the ratio of how much the county assessor said, like say it's a 20% land value, then you assess 20% against your purchase price. But once again, a cost seg vendor will do this for you. Sometimes the cost seg vendors may ask you or your CPA, and then that's when you go back to your county records to do it. Or this other way of how you can do it is your appraisal. And those are the two technical ways to do it. There's the third way, which is the lazy CPA way, is you just take 20% of the price. It's horrendous, but it's like a just a common thing in the industry. Like people, just 20% land, whatever, right? Like it's just generally speaking, like in the Midwest, it's kind of like that, if not less. Hawaii and California, it's not. Like Hawaii is like 50%. The California is like 30-40%. It's not pretty. That's another part when you're buying your houses. Another tip is see how much land value is associated with the building. Like I had one person, it made no sense. The house was down the street, and the county assessor, like, there's like a 20% difference between the land to building value. It made no sense. I was like down the street, but I was like, hey man, whatever the county assessor says, that's what we're gonna take. So that's how you determine the basis in your property is what you paid for it, plus how much you improved it by, minus depreciation.
Great. Next question is from Maggie. Would you recommend doing a cost seg for your newly built second home, which is not rented, but you're intending to hold it for long term, for example, like 8 to 10 years?
Oh, so if it's not rented, then I would not do a cost segregation. The reason why is that you would have a study, but you don't have anywhere to deduct those losses against, and it's not placed in service yet. So the biggest part is like all this is for rental real estate, investment real estate. So if it's still like say a second home and you're not going to be renting it out, then you do not want to use a cost seg. Otherwise, it just won't have a financial benefit for you.
And also for clarity, is like, can we do this on a primary home if I also have other real estate that has like a high, like positive income?
If your primary home, you house hack it, you can. But if it's just your primary home where you don't let any strangers in, you do not want to because you don't have anywhere to write it off on your tax return.
Oh, I mean, like pretend me, like I live in the Bay and my house is worth $1 million, but I also have 6 rental incomes in like various states that's earning various lots of income that's cash flowing.
Mhm.
Can I do it off of my $1 million home and like, oh, I can't use it on myself, but I could use it on my 6 other properties.
Oh, as long as your home here is house hacked, then you can.
Only house hack. So is it a rule like if it's a primary, you're not allowed, like you live in the whole thing?
Correct. Yeah, you cannot because it's not considered rental real estate at that point, an investment. So if it's not investment, you have nowhere to write it off on.
Got it. So like with Mike over in Oakland, in his situation is it's you didn't recommend him doing it because there's no cash flow. But if he did have other out-of-state properties, then it might still be good for him.
Oh yeah, if those properties were cash flowing and they're
I'm sorry.
positive after depreciation, then it'd be great. Yeah, because then you can just use this to go offset other properties. It's
Mhm.
a good strategy that way too.
Yep. Or if if they are investing in syndications or something and there's some positive, then that can also help with balancing out the profit that comes from syndications.
Yep, these syndications. Yep, that's a good one. Yeah, the other one was, yeah, that's kind of like that business example I had too, where you're a passive investor into a business. That's another good one too.
Good.
Yeah.
See, Mike, it's not a hard no. It's a it depends situation again.
One day soon. Yeah. Once you get that second one, my man. Yeah.
Well, next one is from my homie Arthur. He has to sell a couple buildings this year. Ooh, with significant taxable gains. Is it significant enough to cost seg another building to offset the capital gains?
I'd say so. Yeah. Just because. if you don't, then yeah, you're just gonna have cap gains to pay on it. And yeah, if you don't want a 1031, you don't want to opportunity zone it. There's this crazy strategy I just learned about. My head hurt after walking on the call. So I was talking to this wealth advisor, and the barrier to entry is very high. It's this is why the rich get richer, for God's sakes, but essentially you need at least quarter million, but generally speaking, it worked better at $1 million. But essentially it is a strategy where they create capital losses for you to offset your capital gains. Is like the long story. Like they make their 2% of like assets under management, but then they also create tax efficient investing. So if you have a portfolio just to go start creating capital losses on, then this is good. So the reason why I came across this was one of our clients, he has a huge capital gain from a business exit coming up. So they're working together to start creating massive capital losses to offset the capital gain. So that's another strategy. But yeah, if the simple, short, sweet answer is that if you sell these properties and just lazy 1031 exchange it, you'll be fine also.
Yes. Go Arthur, go sell all of your houses in Phoenix so that you can go back into commercial real estate. But he's going to be paying a lot of taxes.
A lot of taxes,
He's not
yeah.
doing the 10.
I'm actually selling some of the commercial buildings.
Are you selling the commercial? I thought you're selling the homes. This is
I'm
single family.
I'm selling, yeah, I'm selling some commercial stuff. It's just
Oh,
some things make sense to hold long term, some just flip it. Um, I was gonna ask, so like the max is 60% for 2024, right? So
Correct.
like realistically, if you cost like a $4 million property or whatever, or like 1 million, right? And then land is only like 80%, right? And then you do a cost seg, realistically, how much can you write off? Say off of 800K.
Depreciable basis.
Yeah.
It's had a calculator on this. So so you take 800 and then you have to phase down. So you have to take 60% of the 800. Then on that 60%, this is where it gets wonky. It ranges from like 10 to 30%. So maybe just say 20%. This is why you want to get an estimate. So if I take 0.2 of that, it's about 96,000.
that's it.
Yeah, that 60% is killer because if you had 800 and it's at 100%, you're probably looking at 160,000. So that 60% phase down really is hurting this year.
Ouch.
But that's like a more conservative too. That's always why you want to just grab like an estimate just to see what's going to happen. But just to be generally conservative on that side, it could come out a lot higher, but just to give you a ballpark.
Mm,
Gotcha. Thanks.
Yeah. Mm-hmm.
that stinks. All right. Next question is there a certain home price to income ratio that doesn't make sense to do a cost seg? For example, say you're buying $100,000 home and your annual income is $1 million.
So you buy $100,000 home and then what?
So like does it make sense that if a certain home price to income ratio that doesn't make sense? Like if the house is really, really cheap, but your income is very high, and
Oh, yeah.
do you have to be an REP to be able to do this to offset active income?
Yeah, I'd say probably like if it's so like if we just do the math right here. So say we just do the math and say it's like $200,000, 200, and then we take out land, then you take out the phase down. It really depends on the phase down. If it comes back at 100, so let's just go best case scenario and say it's 100%. So times, say zero point 0.2 is my general ballpark. It's like $32,000 of extra depreciation. So if you are reps though, and you are able to save $32,000 and you're at $1 million, that means you're paying 37% in taxes. That's $11,840 in tax savings just on the Fed side that you're gonna get, subtract out 2,500 $2,500 for the study. It's 9.3K still. So yeah, I'd say like $200,000 still kind of makes sense. $100,000, just divide that by half. So that's only like a $4,500 tax savings. So maybe not as much. It's also like Yeah, if you make $1 million, you really don't care about 4,500 bucks, but you may care about 10 grand. I don't know. I'm not a millionaire, so if someone has that, it's perspective, right? But generally speaking, I would say, yeah, those lower properties, 100, may not be as worth your squeeze.
Yep. All
Yeah.
right. Next question is, so it's from Eric. Uh, it's a little longer. My
Mhm.
cost seg company didn't send someone out, but it did a Zoom call to do the house tour. Is that a red flag?
It depends answer. So the Zoom tour, I would say that's actually pretty good. That they did a tour. Like 9 times out of 10 these days, people, what do you call it? They just use all the photos off of Airbnb. They don't even come look at the house anymore. So this is a post COVID or COVID. This the cost seg game changed. So that's the technical. Like it looks good. I was speaking to a cost seg firm owner though. He was on the board of like cost segs or something crazy. And there's IRS tax auditors at this conference. And they asked them like, per the audit technique guide, would these Airbnb photos or a Zoom tour hold up? And they didn't directly say, but they indirectly said that it would not. But generally speaking, they can't like say it, of course, but they said like generally on-site studies will pass the audit technique guide. But if you almost think about it, Airbnbs these days have so many photos, it's almost the same. So I think it's really going to come down. So this is where the judgment call has to happen is like, if you send someone on site, that's going to be an expensive study because if you already think about it, $500 for a flight, three $300 a night for a hotel. That's 800 added, and of course you got to pay that person's labor to do it. So that study's gonna be 4, 5, 6K. And do you want that peace of mind though? So once again, you're paying for that peace of mind. But I think Zoom's better than most. A lot of people are still doing photos, which is a good argument. You just really have to wait for the audit to blow up, I guess, is the main part. But I'd say Zoom's good compared to most.
Cool. And then second part to Eric's question. He just started a cost seg and he just paid half of a fee for a new purchase about 10 days ago. But he plans on doing a small remodel to turn a half bath into a full bath. I didn't know that I should have waited to do the cost seg. Does it make sense to finish up the cost seg at any point? I know each company is different, but is it common to allow a delayed cost seg?
I'd probably just contact your cost tech vendor and just be like, yo, I got a bathroom going to be remodeled. I'm going to drop 10, 15, 20 grand on it. Do you want me, can you guys like hold off on the report? I'll send you over the improvements. And then can you like update my report on that? So I probably just have them just wait unless they tell you to like de minimis the whole thing. I just don't know how expensive your bathroom will be, but if it's gonna be more substantial, then you probably do want to wait just so the whole audit or the whole study comes through, including the bathroom renovation too.
Right, and then do you talk with your company because sometimes like if you already finished and you did do some major renovations, if you send them the information, they can help you actually update your COSEG report. When I guess it most is just before you submit it to your CPA, I guess.
Yeah, we found a pretty good happy medium with our current cost seg white label vendor. They're like fully like they're also board certified and then also they're pretty fast. Reports look good too. They're coming about like depends on the cost, like anywhere from like 13 to like 2,300 at like wholesale price. So the market is just expensive now. Like I'm like, damn, bro, this is wholesale price. I'm like, what's like the consumer price then? But it just depends on how big and crazy the property is too. If it's a big property, it's unique and there's not very many other comparables, it's always going to cost more too.
And then the third part of his question is that, um, are there any negative tax implications with cross-state COSEG? So, for example, if he lives in one state and he purchases the rental property in another state.
No negative consequences. However, your domestic state that you live in, those state taxes will not go down. So let's just pretend that, you have your house in California, you live in California, you bought a house in Arizona, you run a cost seg in Arizona, those losses only reduce your federal income tax liability. They do not reduce your California tax liability because your house is in Arizona.
Is it that California doesn't accept these things or it doesn't?
California doesn't tax that income because you source it to that other state. So you have sourcing. So yeah. It'll still save you on the Fed side though. So still worth it. But yeah, don't have an expectation your California income would get reduced.
Boo! Dang it, California.
Yeah, California, New York. I think New York's actually the worst. I used
Worse
to say
than that?
California,
Really?
New York. Yeah, New York, I think is actually worse than California. Now that I've seen more and more like BS that comes out of it. New York, I found out the hard way was apparently if you pay your kids in New York, you have to buy workers' compensation. Even California doesn't require that. So like I think they're the only state in the whole nation that because we were doing the pay your kids strategy and that blew up my face. And I was like, oh, lovely. But yeah, when New York, you have to buy workers' comp for your own children. Yeah. Because you know your children are going to file a workers' comp case against you. So it's like very silly.
It's like, I'm not gonna sign off on you having your own lawyer to sue me. I'm your parent.
Uh, I was like, wow, New York. I was like, Jesus, you're worse than California.
Are they really? Because I thought California also doesn't accept, was it the REP status?
They don't accept Excel. Oh, actually, so that's a good thing here. So California does not take bonus depreciation,
Okay, bonus.
but they do take accelerated depreciation though.
So what
So,
is the difference?
oh, the difference is here is so in
Like
uh
the reading between bonus depreciation and accelerated depreciation.
oh yeah, so if you're in California, so you take 24.5 divided by 5. So let's just say this is 25K divided by 5. You get 5K for California because it does not conform to federal. Unlike on the federal side, you get the full 25K. So California says, I'll let you do straight line, but I will not let you do bonus depreciation. So California will give you 5K, but the Fed will give you the full 25K though for bonus. So California does not let you do that. So you have to straight line it out, is how California works.
So Tony, are we sure the two of us want to stay in Richmond, or are we thinking about another state soon?
Oh no, the
I'll
base.
really be in the You're lazy as hell too.
Yeah, it's so comfortable here. Yeah, the weather is too hard to beat. I mean, it's been windy and cold, but I think it's better than that should be a poll in us there. Would you rather roast in Texas or like just
But all the tax benefits.
pay silly taxes in California?
Hard to say.
Yeah.
All right, next question is from another Californian. What's the property age to qualify? Would a 2010 single family home qualify? I, I don't think property age has anything to do with this, does it?
Not correct. Yeah, property age doesn't matter. It only matters in terms of when you placed it in service, though. So, say you had a 2010 property, it was built then, and you didn't rent it out until 2020, cost segregations would still apply. However, if it was built in 2010, you rent out in 2011, like the ship has sailed just because it's past 7 years. So your cost seg's not going to bring back enough depreciation to warrant the cost. So build like if you want to take a more extreme example, like my dad has these houses in St. Paul and they're like made in like the early 1900s. Like he could still run cost segs on those. It doesn't matter, just because of like when they're built, but it's always about when did you place it in service and when did you start depreciating it on your tax return.
Mhm. All right, next question. Oh, I'm going to need you to grab your crystal ball from your super cool Tesla because Stanley asked, how likely is a 100% bonus depreciation coming back in 2025?
I mean, I got all my fingers and toes crossed because it makes my tax planning life way easier for our clients. But based off of what a lot of cost segregation groups have said, and then seeing what Trump's been saying, I think there's a very high likelihood that it will come back. If not, like it's not going to be pretty. So I'm really hoping it does, but I would bet some decent cash that it will come back.
Definitely, because as a real estate investor and someone who runs SEER, my life has been really boring now that, cost tag has gone down so low and like fewer sales going on. It's not as fun.
Yeah, there's
Right.
yeah, then interest rates too, just it does not help. So like even if you could get a higher tax benefit, then you can invest still. Of course, you don't invest because of tax benefits, but it does help pad the numbers on your underwriting.
It does, for sure.
Hmm.
Right. And then, so speaking of all the pricing and all the cost seg, so Martin asked, have you started seeing any cost seg AI tools yet?
The not for not domestic, D2C use. So there I have not seen any yet on that side, other than like DIY cost seg, but like you might as well not do it. There are firms that are popping up though that are B2, like B2B, like B to you guys, will sell to you guys, and their engines are powered by AI though. Like you see the report, my yep, dude, this looks like doo doo. So you might as well not use it still. And I'm knocking them. I'm just saying like you have to what do you understand? The IRS is very old school. The audit technique guide is written very old school. So you unfortunately have to play in the old school games. Like I love like AI. I mean I tried sending a tax return into it just to see what it comes out and it didn't come out well. But I mean I'm like tempted.
Is it because you're not using the $200 a month account and you're just using the free one?
Oh no, yeah. Oh no, I switched to Claude instead of ChatGPT actually.
That's
Yeah.
good. All
Yeah, I
right.
paid for Claude, but yeah, I don't I stopped with ChatGPT. But no, it's just AI doesn't yet understand the exception to the exception to the exception. So taxes, that's why it's always a it depends answer. As big as a joke as we make it sound, it's always an it depends because one extra factor will actually throw off your tax result. So AI is not there yet. And I bet 18 months from now, it could be close, I bet. So another SARE member and I were chatting, and it was maybe like a project after tax season, like how do we build an AI to replace myself, more or less? So, but you have to understand all the exceptions is the issue.
Yeah, it's kind of hard, especially for the memes and videos and stuff to clone yourselves.
Oh yeah, yeah. Uh-huh. Yeah. But yeah, no, it's no AI D2C tools yet. But you can know B2B, but they don't say they use AI. Like I doubt you sell it from that. Otherwise, you're gonna expect a lower price and it's probably not come out as hot yet. So I haven't seen it yet.
All right, I need your crystal ball again. So, ooh, is there possibility that Trump can apply the 100% bonus depreciation retroactive to 2024 if it's not been filed yet?
24, no. The all the chatter's been for 25, actually. So 24, yeah, for sure. Yeah, you can probably just file that return, you'll be good. They won't go at retro on that on 24. So it's at 60%. That's why the strategy is that if you wanted to like not do it in 24, you are going to lose some tax savings, I'll be honest there.
Yeah.
But you could get and it goes retro for 25. Then you could just run your cost seg in 25, get the full 100% and not have to lose out on that 40%. So also when I say lose out, you're not losing the 40%. You're just delaying how fast you get it. For example, like this 5-year property here, instead of getting the full 25K, you would just get 5K and then you just take 5K, 5K, 5K until all 5 years are up. So, or sorry, in this case, you would get 25 times 60%. I can't do math anymore. So you take 25K times 0.6. So you get 15K this first year, and then that remaining 10K that you don't take, you just take 2.5K for the next 4 years. So that's kind of up to you. But yeah, there has been no like chatter at all about 24. I think they've just called it a wash at this point.
Okay, then I'm trying to think more crystal ball type of question, as in like, okay, if it's ending in 2026, so right now it's 2025, pretend Annie buys a new property.
Mhm.
And should I hold off on running that cost seg this year because I know it's gonna be like, what is it? Did you say it was 20% this year and zero next year?
40% this year.
40% this year and then 20 next year. So should I just say I'm going to hold on to it and then don't even do the cost seg this year and then wait until 2026? I always extend my filing anyways. In 2026, maybe we might hear back on it's getting changed or going back to 100%. Then maybe 2026, that's when I should do the cost seg.
If it goes back to 100%, yeah.
And
Yeah,
then
I
if I
would.
don't, it sucks because I now it's dropped to 20%, right?
Yeah, yeah. As long as I would just wait and delay it until you run the cost seg, just because it's such a slow rate. Like until the government finally gives us clarity on it, just don't run the cost seg yet.
Mm.
Yeah. Uh-huh. And then yeah, of course, always buy the property based off of non-tax underwriting. Yeah.
Yes, folks, when you're buying real estate, it should actually just at least break even or do well by itself, not because you're banking on like depreciation or all these other things, or even like raising your rent. Like just underwrite a little bit more conservative, and then if you get these things, as you get it, like if, consider it as a phantom income or just bonuses for yourself. But make sure that your deal actually works first.
Yeah. Bonus is a good word. It's just a nice cherry on top.
Exactly. All right. And then Fong asks, if I'm planning on adding an ADU on my property at some point, should I do COSEC now or should I wait until after the ADU is completed?
Oh, what's up, Paul? You just wait until after the ADU is completed, just because of all the materials and everything that's going to go into it. You could actually hack it if you wanted to and not run a cost seg, where if you have the full listing of everything, you could just hack it where you have every single thing from the lumber to the floors to the sheetrock to everything, itemize it out, and then you'll be able to break out into 5-year, 7, 15-year components without paying for a cost seg. So it's just a lot of tedious work. So do you want to like spend all the time to compile that and then will your contractors give you that level of detail? Or are they just buying the supplies and calling it a day and just charging you a lump sum? So yeah, depends on like how much time and effort you want to put into it. You could hack the cost seg. So kind of up to you. But yeah, wait until it's done.
Right. And then are there any additional examples of where COSEC can play in very well with like stacking up on other items? Because we talked about the like, or maybe actually more on the 1030 lazy 1031.
So you'd stack on lazy 1031s. You would stack it against other profitable properties. That example you used already, where if Mike bought properties out of state and they're very profitable, then cost seg the Bay Area home. So that's example number two.
Short-term rental loophole.
Yep, short-term rental loophole. Pad splits is another part where it's highly profitable. What's the other one? Commercial real estate, we said that one.
Mhm.
And then passive business investing too. That one's always going to help you win a lot more too.
Yep. And then we also see like syndication companies, like if you're buying multifamily or something, in the first couple of years when you're investing it, they usually will do a cost seg as well. And so you'll see the major savings in year one against your other rental properties.
Hmm. Yep.
Cool. All right. Eric asked, for my Airbnb that I just purchased. Dude, you don't call just purchase when it's 10 years ago. Just saying. But Eric says for my Airbnb that I just purchased 10 years ago, should the furniture such as beds, TVs, tables be included in the cost seg?
I'd probably just exclude it just because you could probably just de minimis election all that right away.
But can you
So
actually cost seg stuff? Like it's not part of your actual house.
yeah, cost seg generally speaking is for proper like for affixed structures to the unit. So like you always depreciate assets that like if you were to remove them, they would material affect the house. So, but all those items do count though, because it is you bought it for business purposes. So like say you have an Airbnb, you bought the beds, you bought the frames, you bought the TVs, you bought the drawing boards, like all that stuff, the gaming stations, all that's a write-off. Yeah.
Oh, that's so annoying to have to like track all of your furniture for that. That's ugh.
Oh yeah.
Next question is from Martin. So it's going back to about what we talked about for syndication. So this is the issue with syndication, they don't trade or 1031 exchange. So the cost segregation gets recaptured. Is that correct?
Yeah, so on a syndication, generally speaking, they won't 1031 because when you have the 1031, all the same owners have to be in the next deal, or you have to have a tenants in common situation, but most syndications won't let you do a tenant in common situation. So yeah, the cost seg gets recaptured. So you have to pay back the taxes, but at the same time, you took that benefit already and you'll have a big cap gain or a big capital sum of money to pay back. But yeah, that is a real thing. And then also at the same time too, you would probably just go and take your same money, invest into another syndication, and then this is where you more or less do the lazy 1031 exchange as an example. So, but if you just the hard part is in the tax world, you can't ever really have your cake and then eat it because you can't have money and not pay taxes on it. That's the crapshoot with the tax game.
Yeah, Martin brings up an extremely good point is that there's a lot of syndicators who are trying to market their deals. They like to advertise about their losses, like saying like, okay, you're actually gonna get like X amount of distributions. Yeah, you're not really gonna be taxed on it because we're gonna do a cost segregated study, so it'll be zero. It's not gonna add additional taxes on you. But then oftentimes what they fail to do is to explain that, okay, at the end of the 5 years when it's time to sell, you do have to do the recapture on taxes. And so a strategy from a lot of syndicators, what they do is they try their best to avoid selling in December or like during the end of the year. And it's really the best idea for them to aim to sell in springtime or during the summer, because the idea is that you're going to have a little bit more time for you to find another deal, either that they're buying another one at the same time. That's how they really do try to time is that they're about to buy it so you can reinvest your money back with them. Or if they don't have any deals, then at least it gives you months to look for another syndicator and put in money on their next deal. But you are correct. They don't talk about it, and there will be a tax hit at the end for the recapture.
Yeah, I actually don't. I'm not like a big fan of those folks, anyways, because it's not quite false advertising, but it's like deceptive because it's like, hey, invest in my syndication, you'll pick up losses, but like, bro, like the losses are passive. Like, unless you're reps, you're really not going to be able to utilize it, or you have other passive positive income. You can't really do it. Like, I understand, like, after learning sales and how that whole game's played, but I still find it a little bit deceptive for those syndicators that say that.
Very much.
Yeah.
And for those who advertise dollar for dollar depreciation, no, that's false
Oh,
advertising.
that's a stumpy yes at that point. Like, you have to
Bullshit.
be paying 100% in taxes, and the max rate, even if you live in California, is like 51%. Like,
Mhm.
it's not that bad. Yeah.
Right.
Definitely false advertising for sure. Yeah. But I guess you got to raise capital. But then also at the same time, I don't know much about the operation side of syndication, but like I probably question who the operator is at that point. Like, and are you that desperate to go get funds, right? And then I also would question how well is that performance going to be. But that's a whole not tax related thing. Like I'm a tax person at the end of the day. I'm not a financial person.
We have to ask Tony Lynn for help on that question, and that
Right?
is, I
Exactly.
don't know if he can even answer that after that point.
Yeah.
Cool. So going back onto the syndications again and also the depreciation. So Stanley asked, in that case at the end, when they do sell, we're gonna have to get hit with a syndication for the recapture and the capital gains tax. So what if you don't want to join another syndication in the same year? What are other methods that we can compensate for that? Do we need to find another rental house or house hack for primary? What do we do to avoid that big tax bill when my syndication gets sold?
Um, there's a lot that you can do. I would say, so you sell a house, you have depreciation recapture, you have to pay that. You do have a capital gain, so you have to think about your capital loss. So it's either one, so syndication, yeah, so you have to do a lazy, late, like you buy a new property, you cost seg it. That's option one. Option two, you get into some depreciable base, like depreciable business, example, laundromat, RVs. We've had clients that done that. Option three is that you could help lower your overall tax liability by using like leveraged charitable donations. Hyper aggressive, but saves a ton
Wink,
of
wink,
money,
Sarah scholarship.
right? Donate funds. That's true though. Donations will reduce your tax liability. And then tax loss harvest, actually. So that's actually an easy one. So if you have bad positions, sell off all your bad positions. And then also there's that one. It's so, what's it called? It's called like that one wealth advisor I was talking about. It's called a short long investment, and essentially that's the one where that wealth manager creates tax efficient investing for you to get a crap load of capital losses to reduce your capital gains. So in those years you do, or the probably the year in advance actually, because you really have to plan this out pretty well, is to talk to some tax strategist or tax advisor or your CPA and see what you can do to start planning to reduce those taxes.
And then, so, okay, maybe use myself as an example. So I have I have like four properties that are rentals, and I've done cost seg on those. So pretend my deal with one of my syndicators are about to sell, which I hopefully soon. Okay, so if I sell and there's supposed to be the capital gains. I'm a W-2 worker and I can't really like use all of the cost seg savings that I have. So it's being built in my piggy bank. Will that be useful to help offset some of the stuff in the sale?
Oh yeah. So when you do sell that, the passive piggy bank actually comes back to play here. So if you have rental properties and you've been accruing all these passive losses forever, these passive losses will actually unlock to help you reduce the taxable income on that side. So that will definitely help you on that side. And then if you want to buy other property though, that's another good time. Or like get into another syndication if you want to get into other syndications, but with a fine grain of salt.
So,
Who you
but depreciation helps with capital gains, right?
The appreciation will help with so you sell the syndication sells, right? And you have cap gains and you have depreciation recapture. You have two taxes.
Hmm.
Yeah, so you need a way to reduce the depreciation recapture.
So my piggy bank is really only helping on the depreciation part, for recapture, but not the capital gains from the actual sale.
Cap gains not as much, yeah. Yeah. Yeah, cap gains, I
Oh,
mean, it's not
sorry.
bad just because it's still like 15, 20% versus the full ordinary income tax rate, 22, 24, 32%.
And then when you said with the recapture, was it 25% flat, or what does it do anything with like my income tax brackets?
The recapture, no, it's always 25%.
Oh,
Yeah.
gotcha. Cool. I think I hit all of the questions in there, and I've been trying to think of like the weirdo situations where we can combine things.
Oh, there you go. Nice, nice. You're thinking for the people. Yeah.
Yeah, it's like using myself as an example, and I was like, huh, I don't know what I did, but I didn't have to pay taxes that year, and I was so happy. So stuff like that.
Nice. Yeah, nice. That's good. Yeah. No, yeah, cost segregation depreciation is really the name of the game with real estate and how to unlock these things. It's not taught in it's not taught in school. CPAs like may not talk about it. So it's a good tool. Add it to your toolbox. I think hopefully by tonight's call, you know what to do with it. If not, reach out to us. We'd be happy to help. And same thing with anyone in the crowd. Annie knows a ton about cost X too. So yeah, great tool. Just know when to use it the right way.
Yeah. So, but before we end, can we go back to your slide? And if people have questions or they want to get in touch with you, how do they get to you?
Oh yeah. Yeah, so let's see. Yeah, so feel free to everything's the CPA dude. So yeah, we got $1,000. I forgot to put the word off on our advisory packages if you want over the next 3 days. So just mention this webinar. And then yeah, everything's CPA dude. You can email me, Instagram, website has the booking link if you want to talk to one of our advisors too. And yeah, that's the easiest way to find us there. The Facebook, I'm pretty slow on these days, but I get there eventually. But yeah,
Can
website's probably the fastest way actually these days.
can you tell us what is the advisory package? What does that include?
Yeah, the advisory package is our full, I think I can probably pull it up here, cpadude.com, tax vision. Yeah, so this is like our full like loan like flagship service. So it's more or less you're getting a tax plan. So we draw that up for you per your situation. Then we also go over your deductions, talk about your entity structure. If you need like a single member LLC, we'll help you form that also. Talk about your retirement, insurance if you need it, tax law changes. And then twice a year, we do review your tax position with you. So it's like just a strategy call, see what's changed on that side, and then educate you along the way. And then also, you'll have message support to like the whole team also. So for for the whole 12 months. So that's kind of like what everything is. And then the other package is just we file the taxes, provide audit protection, do a couple quarterly tax estimations for you there too. So that's overall what our tax vision method is from a process.
Yeah. Awesome. And we do have a lot of our fan club in here for the CPA dude. So go and check it out and ask questions. There's also other services that he has, like with Circle. It's like kind of like weekly office hours for just like quick questions and things to clarify or just to plan your stuff. So if you guys have questions, please go to the cpadude.com and then also catch him on Instagram because he has a lot of really cool posts up there to teach you guys more things. But other than that, as we will continue holding these type of webinars, it's usually like every other month whenever we think of really cool topics. And please do send us ideas or contribute by sending us weird questions where we can stack up and learn things. Aside from that, I did record this, and we'll be sending this out to everyone who registered today. We'll send that out tomorrow morning, or maybe depending on my VA, if she's up, she'll get take care of that for you guys. But without further ado, thank you guys so much for your time, and I will catch you guys in a bit. Bye bye.
Have a good
Thanks,
night.
Tony. Good night.
Thanks, Tony. Thanks, Annie. Good night.
Thanks,
Goodbye.
bye. Bye.